Hello everyone, my name is Emily and today we will look at some of the basic terms so you can feel more comfortable before you start trading Forex. There is lots to learn, but here we will give you the most common terms used by traders. If you want to learn more, you can always head over to our website and read our terms in our glossary under the IronFX school. So, the first one to look at is the currency pair. When you trade Forex, you will see that you're always trading currencies in pairs. One currency is bought while the other one is sold. Together, they make up the exchange rate. So what is an exchange rate? This is the rate of which one's country currency can be exchanged for another currency. We talked about currency pairs. Each currency pair is made up of the base and quote currency. So what is the base currency? This is the currency that comes first in the currency pair. So for example, GBP USD, the GBP is the base currency. So what is the quote currency now? It's the second currency quoted in a currency pair. So for example, GBP USD, the quote currency is the USD. Traders also refer to going long or short. Let's see what these two terms mean. A long position refers to buying an asset with the expectation that its price will go up. On the other hand, we have the short position, which refers to selling a currency pair with the expectation that its price will fall. Two more terms that are linked is the bid and ask price. The bid price is the market price for selling an asset, and the ask price is the market price for buying an asset. Now, many traders also refer to small and big spreads. Let's see what spread means. The spread is the difference between the bid and the ask price. Thank you so much for joining us today, guys. See you tomorrow. Bye-bye.
The financial markets tend to change all the time. A good trader should either adjust his trading to reflect this change or can place traders and wait for the market to move in the wanted direction. Having different strategies and ideas on the side can increase your winning possibilities, as to force you to think in terms of different time frames and trading sessions. Some of the best Forex traders in the world are excellent at mixing up a number of strategies. Basically, you should be able to change your approach with the way the market changes. Embrace change, stand in the midst of it. This will make you wiser and tougher as it will challenge you. Sharp moves in Forex markets are big surprises. If everyone expects something to happen, they position themselves before the event. Basically, if the event actually plays out as expected, very little may happen during and afterwards in terms of market action. But if very few expect something to happen, and it does, we usually see sharp moves in the following minutes, hours, days, as investors revalue their views and reposition accordingly. In such instance, positions in the wrong direction incur losses and sometimes extensive ones. It would be advisable, in order to protect your funds, to use a stop loss when placing an order or diversify your positions in order to mitigate losses.
right, let's begin today's session. Okay, guys, thanks for tuning in nice and early, right? If you're here for the first time or if you're here, there is a chat section. I'm just going to send a message through, right? That is a section, right? I forgot to change my name, right? Just let me change my name. Just let me change my name. I rename it to Desmond, all right? Okay, yeah, if you're here, there's a chat section that you can there's a chat section where you can just send your messages through, right? And I'll do my best to answer them. Kingsley, the recording should be sent to your email, right? Hopefully it'll be sent to your email, right? I'll need to check up with IronFX on that. But today's session is a very exciting session, right? It's actually going to talk about very, very effective style of trading. A trading strategy which I've used very effectively, right? Made good amounts of money with it, right? And it's a pretty, it puts together what we've learned so far on support and resistance, pullbacks, overlaps, what we learned last week, and we're going to apply it this week. All right. Now, let's begin today's session. Okay. First and foremost, of course, disclaimer, everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. Please do your own little due diligence before you guys trade, okay? Now I see Natalia has tuned in too. Nice to see you here, Natalia. I thought I'll be seeing you in the VIP room. I didn't see a registration come through. I was looking out for you all week, man. Right. But all right, let's continue in today's session. For those of you all who are here for the first time or wondering who am I, right? My name is Desmond Leong. I run the award-winning research firm, Everest Fortune Group, and also the Forex Army, right? Where is my marker? I have a little marker over here. Yeah, so we are finalists for 2019, 2020, and 2021 for Best FX Research, and 2020 and 2021 for Best Equity Research, right? Really strong team of traders, right? And we usually work with the institutions on telling them where the markets are heading, but we have a special partnership with IronFX, where we're bringing you guys the good stuff, the juicy stuff, the stuff that will take your trading to a next level. Right, yeah, Natalia, I'm waiting for you, man. Let me know if you're in difficulties joining the VIP room, all right? I'll give you guys a link to get access to it later, okay? Now, if there's anything I want to encourage you guys is that, yeah, you know, I'm a very young guy, 32 years of age, right? And if there's any word of encouragement I want to share with you is that you don't need 30 years in business, right, to be a good trader. You don't need 30 years in Bloomberg to be a good trader. You just need 30 days learning the right stuff. And here at IronFX, we're going to teach you the right stuff on how to be a better trader, okay? But of course, whenever you have questions, please send them through so I can answer them. Otherwise, you know, it's going to be lonely if it's just me talking to myself. All right, guys? So yeah, please, anytime you got questions, just send them through. Now, let's begin today's session, right? I'm going to touch on trend lines, right? The ways we can use trend lines. Then we look at channels. Right? Channels are, you know, trend lines are, are up and down. Channels are essentially parallel trend lines, right? There's a proper way to use it. I'll touch on how you can use this to improve the probability of your setups. And I'll be showing you some live examples on some of the calls we did that turned out really well, right? And it's actually a way to apply this form of technical analysis into trading, right? If you apply it properly, trust me, it can be one of the best and most profitable kind of trading strategies you encounter. Okay, now let's move on from here. So just remember, when it's a recap on our last week's session, always look out for significant swings. All right. It's very effective when you're doing trend lines. It's very effective when you're doing channels, right? If you draw a trend line like that, you know, you look at the significant swings. You look at the significant swings. Okay, we usually don't try to use the smaller insignificant swings over here. Yep. So these are the insignificant swings. They're not that useful when you plot like little channels here and stuff, right? You're looking for the bigger levels to plot your trend lines. Okay, so always keep that in mind. Now, okay, these are significant multiple swings. All right, so this is really quickly what one of the key things I'll be showing you later, right? We did touch last week on the multiple swing highs, right? Multiple swing highs. When you combine them together, you can find a very nice level of resistance or support. I'll be showing you how you can use this in your trading this week. All right, pretty interesting stuff. Pretty interesting stuff. Okay, now let's first look at trend lines. Let's first look at trend lines. Remember, guys, again, I encourage you guys that if you have any questions at any time, please send them right through. I'll do my best. I literally have another screen open here to answer you guys. Okay, now trend lines, right? So one of the questions that we've always wondered, right, is when you use a trend line, do you use the week or do you not use the week? Right, so this uses the week. Some people prefer not to use the week. Okay, now I'm going to give you guys the answer here is that when you're drawing trend lines, one of the best things to do is to use the week, right? So you notice that when you change the trend, when you change the time frame, like for example, if this is the H4 time frame, and you change it to H1, oh yeah, so Techno is asking where people can access my clips on me teaching. That's a good question. I realized I forgot to cover that with you guys, right? I'm gonna show it to you over here. For the upcoming webinars, right? For the upcoming webinars, all right? So past webinars is over here, upcoming webinars is over here on the main IronFX website, okay? So past webinars, that's me, that's Cass, you might have seen her, right? So this is the, if you want, you filter based on English and you can see all the different past webinars here. It's really, really nice. And you can kind of see what we had taught for the session. You want, you click watch webinar and there you go, right? It's over here, right? It's a great session.
Consistent.
This was Cassandra.
If you are crossing the
I kind of thought usually there's usually a recording of self somewhere. Yep, there we go. Okay, so that's where the past webinars are. And of course, you know, if you want to watch, please do sign up for upcoming webinars, right? The upcoming webinars, we have our upcoming webinars. It usually takes a while to load over here, right? You can click on English, right? And after our session this week, we're gonna have our top price action setups next week. All right. Yes, you can access it on YouTube, right? So this is actually the YouTube playlist, right? And we are gonna click on this button called here. This is the link. This is the link that you want to go to. This is the playlist on YouTube. Okay, so yeah, you know, you can come in here and you can watch the webinars over here. Okay, pretty good stuff. I think it's you just need to watch each and every one, right? So like last week's session, some pullbacks, overlaps, and swings, you know, you can check it out over here, right? So anytime I'm referring to my previous webinar, you can check it out over here. Okay, guys, I hope that answers your question on where you can find it. Okay, now let's go back to today's session. All right, let's go back to today's session. Okay, so like for example over here, H4, right? When I change it to H1, right? For example, if I change it to H1, you notice that there is all the different bounces that happen over here. It is the same bounces that happen over here, right? And that is because we take the wick, right? If you don't take the wick, in this example, right, this is when we do not take the wick. That's where it becomes very, it doesn't look that nice when we draw it, right? So on the H4, it might look nice, right? We're not taking the wick on the H4, right? You can see that we ignore the wicks over here, we ignore the wick over here, ignore the wick over here. But what happens on the H1 chart is that if you change the time frame, you notice that it becomes like this, you know, it just cuts right through and it doesn't look very nice, right? So that is the reason that when we are drawing, when we're doing technical analysis, when we're drawing trend lines, always include the wick, right? Because when you include the wick, no matter whether you're on the H4, you're on the H1, you're on the M5, you're on the M15, right? All of it will give you the same reading, right? But if you use no wick, right? No wick, you will get stuff like this where you have absolutely terrible example. Let me show you an example. Let me try to show you an example over here. Okay, I'm just going to load my chart. See. Let's see if I have an example somewhere that we can look at. One where there's a very big wick or something. Let me just check it out. Okay, let me show you the difference, right? So on the H4, you look at this. Let's ignore that wick over there. Let me find a wick. Okay. Now for this example, for example, right? So imagine if we drew like this line, and we catch this wick over here. Okay. Look at this wick over here. We caught it over here. When I change to the H1, to the M30, oh man, I need to scroll back and forth. It's quite messy. Give me a second. I just drew it, but I can't find it. I'm going to do a bar replay. I'm going to show you exactly what I mean. Okay. Now look at this. It catches it perfectly. If I change it to the H1, it catches it perfectly, right? If I change it to the 1 day, it catches it perfectly at the bottom, right? If I change it to the 15-minute chart, oh, there's no data here, right? 30-minute chart. Is it 1 hour chart? Oh, because there's no data points there. Did I change my price feed or something? Just give me a second. Just give me a second. I think they what I want to show you is that if you take an example, you catch the lows over here. On the H4 chart, it looks nice, right? You're catching the closing price, you ignore the wicks. But if you change the time frame, like let's change it to H1, you can see that suddenly this doesn't look very nice, right? No one would draw a line this way and cut it like that, right? So on the H1 chart, it looks terrible, but on the H4 chart, it looks okay, right? That's why you need to always take the wick, because when you take the wick in examples like this, right, whether you're on the H4 chart, whether you are on the whether you're on the 1 day chart, whether you're on the 1 hour chart, right, let's go back to the 1 hour chart. You can see it over here. Whether you're on the 1 hour chart, it all catches the low perfectly, right? That is why you need to use the wick when you're drawing trend lines. Okay. Now, the next thing that I want to do, right? You notice that this tends to look slightly better. This tends to look slightly better than this. The only difference is the time frame that is being used. Okay, this is the H4 time frame. This is the H1 time frame. So sometimes if something doesn't look that clear on the H1 time frame, right, you're starting to see, you're looking at too granular data over here, right? There's nothing wrong with changing it to the H4 time frame or going one time frame larger so that you see the bigger picture, right? You notice this one, you're seeing a lot of granular data in between, which is not that effective, right? It's telling you the same thing. This and this, they are the exact same thing. Okay, just that this one uses a higher time frame and it filters out a little bit more of the noise. Okay, so this is a little trick that you can use when you're analyzing charts too. Okay, now this trend line, right? How many people want to take a guess? Is this trend line okay or is it not okay? This ascending support trend line, is it yay or is it nay? Is it correct or is it wrong? Okay, I see a couple of answers, right? Some sayings are correct. Okay, let me share with you the answer here. Okay, Techno is also saying it's correct. It's wrong. Why is it wrong? Okay, because a trend line, a trend line support should not be decreasing. Okay, imagine you're a man, right? And you have a slope, and you're walking up a slope. It's very easy to walk up a slope, right? There is very clear support over there. But if you are a man and there is a slope down, you know this is very hard to find support. You just keep going, and then you're walking down. If the slope is very steep, you end up just maybe tumbling down, right? Because it's very hard to find support when the slope is steep, right? As in it's sloping downwards. It's very easy to find support when the slope is upwards. You can easily go up. But when it's sloping downwards, it's a slippery slope, very hard to find support. That's why in such a situation, right, whenever you see a trend line that is sliding downwards, right, stay out of it. It's very hard to catch a bounce when it's sliding down, right? Because you think about it, the overall momentum is bearish, right? If you look at that, price is making lower high, lower high, lower high, lower, lower, lower. It's going lower and lower. As it is going lower, you already have the bearish momentum pushing it down, right? You already have bearish momentum pushing it down. And when you're trying to buy over here, trying to buy to go up, because you have bearish momentum pushing it down, it gives you a much lower success rate, right? Your hit rate usually is greatly affected, right? You have a much lower success rate of catching the moves correctly, okay? So that is an important consideration when it comes to drawing. That's an important consideration when you're drawing trend lines. A supporting trend line should only trend line from the bottom, right? So if you have a trend line, it should only be from the bottom. That is what you're looking to catch: bounce, 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 bounce. Because you have the overall trend going up, it's easier and more effective to catch the bounces when your trend line is going upwards. Now, the same thing is true when you have a downtrend, right? You have a bearish trend line going downwards. That's where, as you can see, it's going downwards over here. That's where, it's easier when you have a descending trend line. So look at this case, we have a descending trend line. We have a descending trend line, but it is at the bottom of price, which is wrong. If the descending trend line is at the top, then it works. But if it's at the bottom of price, it does not work. Okay. So same thing here, it's descending trend line, dropping, dropping, dropping. Very nice, right? That is okay if it's on the top, right? So you're always looking for a trend line from the top if it's descending. Okay, important considerations to take note of, right? 2 trend lines is tentative. 3 trend lines is a valid trend line. So you got 1 trend, 1, 2, 3 touches. 3 touches becomes a valid trend line. Okay, so you can see how you have 1, 2, 3 becomes a confirmed trend line. 4 is where the nice little reaction happens. 2 is always called tentative because there are too many occurrences of trend lines having 2 touches. What do I mean by that? Right. So I just come here. If I were to use a trend line 2 touch every single time, right, there'll be too many of them, right? You can draw 1, 2. Okay, this is 3 touches. It's not bad, right? And you can see how there is like 1 touch here, 2 touch, 3 touch, 4th small little reversal over here, right? But if you use 2 touches, you can literally draw almost every single thing. Here to here is 2 touch, right? Here to here is 2 touch. Here to here is 2 touch, right? And it becomes a lot less effective, right? Here to here is 2 touch, right? So what you want to do is to minimally have 3 touches, right? Then you have this thing called a valid trend line. So at the 3rd touch, it becomes valid, right? Then you look to trade from the 4th touch. 2 touches is just too common, right? You can just literally take any 2 points and combine it together, becomes a trend line. And when it's too common, it's usually not that effective. Okay, guys? Now, moving on to the next topic, right? Which time frame should you use trend lines on? Well, the answer to this question is that you usually use it on the higher time frame, right? So the higher time frames usually on the H1, on the H4, they do slightly better. Even on the D1, the 1 day charts, they work slightly better. On the smaller time frames, they don't work that well. Okay, on the smaller time frames, they don't work that well. So that is just the truth when it comes to using trend lines, or actually any form of technical analysis. All right, guys. Let's move on from here. There are a few things that I want to show you on how you can improve your setup. Okay, so when you're drawing trend lines, for example, the first thing you do is you load up the Ichimoku cloud. To load up the Ichimoku cloud, right? Usually when you load Ichimoku, right? I'm going to show it to you here. Usually you have all this, okay? You have all these things, which is very, very messy. What you want to do is to edit it, and you want to remove everything and just leave the cloud. Just leave the cloud. The cloud will give you a good enough gauge on the momentum of the market, okay? The cloud itself is a good enough gauge on the momentum of the market. So in this case, we just draw a nice little cloud here. Notice that the cloud prices tend to respect the cloud quite nicely. Okay. Now, after you use the Ichimoku cloud, then you add in a trend line, right? So we got a nice little trend line over here. Not only do we have a nice trend line, we also have a nice 38% Fibonacci retracement from here down to here. Not only do we have that, we notice that each time price reverse, it was close to a 99%, right? Reverse once, reverse twice, the reversal happened on the 99%. So we got 4 reasons, we got trend line, we got cloud, we got 38%, we got stochastic, all of it leading to a very nice example of price dropping very nicely. Okay, so that is the important, that's one of the tricks when it comes to technical analysis, right? You don't want to be using just one single trend line to trade. You want to combine it with multiple things together to give yourself the highest chance of being a profitable trader. Okay, you can imagine that maybe if you have the Ichimoku cloud by itself, you have a 30% chance of being correct. You add in a trend line, you got a 20% chance of being correct. You add in the Fibonacci, you got maybe a 10% chance of being correct. You add in the stochastic, you got another 10% chance of being correct. By itself, right, is not going to be effective, like a small chance. But you combine it all together, what do you have? You have a 70% chance of being correct. It's only effective if you combine it all together, right? If you just trade it individually, that's often a little bit too weak, right? So that is the trick to a lot of these trading strategies, is combining multiple factors together to give yourself the highest chance of a profitable trade. Okay, now let's show you some live examples. Okay, I'll show you some live examples of the setups that I evaluated, how I broke it down, and why, how you can apply it in your trading. Okay, if you have questions regarding this, or you want me to look at some other charts or some other instruments, you can let me know and I'll take a look at them. All right, now let's look at this setup over here. So if you, this is the link, right? So each of this, oops, how do just give me a second. I think I have, I need to go back to my slideshow again, sorry. Okay, I'm back here again. Sorry about that. Right. I just wanted to show you a link. It seems like when I click the link, I'm not sure where it loads. It doesn't seem to load. But it's okay. Oh, it does load over here, right? So this all of it is timestamp. So this was posted on the 7th of April.
Back to another session of using technical analysis to find it.
Yeah, this was posted on the 7th of April. So you can see towards the analysis, what we did for the analysis is really simple, right? There was a annotate. Actually, I'm going to just show it to you over here. You can see over here, I'm going to draw, right? There was a trend line, 1 touch, 2 touch, 3 touch, 4 touch, breakout, right? So the trend line broke out. There was a descending trend line that was pushing prices down. There's the Ichimoku cloud over here. So you can see Ichimoku cloud, and price broke this very nice resistance level. Okay, so price on a pullback resistance, it broke a key ascending trend line, which is this one. It has a bearish trend line that is pushing it down, as you can see, a nice little bearish trend line pushing it down, and it's below the Ichimoku. Although it's not as strong, but price is below the Ichimoku. So we concluded that price would drop to the next key level, key support level over here. Okay, what has happened since then? You can see that price dropped perfectly to our target over here. Okay, so this is an example of applying technical analysis to trading, right? Especially playing the trend line breakout, because the moment price breaks out of this trend line, right, it starts to feel very bearish. You throw in the bearish momentum, you throw in the Ichimoku cloud momentum, you have enough momentum to push it down to the next key support, right? So this is one example. I will show you more examples. Let me just show you another example over here, right? So in this example, price broke out of a channel, right? You can see nice little a channel. Requirement for channels is that you must have 4 touches. You got 1 touch over here, 2 touch over here, 3 touch over here, 4 touch over here, right? 1, 2, 3, 4. Price broke a nice overlap resistance turn support, right? So you can see that there was this nice little resistance turn support, right? So price broke out of it and it's coming back down, right? And this was the level where it kind of broke out of the channel too. So you got 2 of it. Price then broke a 23% retracement. You can see a Fibonacci retracement over here, 23. So whenever price breaks a 23% retracement, the next level that it likes to go up to is the 38% retracement. Okay, so we believe that it go up 38% retracement and price cross over the Ichimoku. If I'm not wrong, the Ichimoku was over here when we drew this example. Okay, you can see how 4 things all lining up very, very nicely over here. And what happened, right? You can see we are going to call for this bounce up to here. You can see over here, price bounce up very, very nicely to our overlap over here. All right, so it's a very, very nice setup, very, very high probability setup, right? So each of these, right, this could have been a 30% chance of being correct. This could be 20% chance, right? This could be 20% chance, right? This might be 10% chance, right? So by themselves, they're not good, but you combine them all together, right? You combine them all together and you have maybe 80% chance of being correct on this setup. Okay, I'll show you a couple more examples, right? And remember, guys, if you have any questions at any point in time, just send it to me and I'll be more than glad to answer them. This is another example that we're looking at. So this is a continuation. This was a super duper duper nice setup. Okay, so you notice that there was price is testing a bearish channel resistance. Why is it a channel? 1 touch, 2 touch, 3 touch, 4 touches. Actually, about 5 touches, right? We got 1, 2, 3, 4, 5 touches. Price is testing a pullback resistance, right? 1. This is a pullback resistance over here. What does a pullback resistance mean? You can check out our previous webinar on that. Okay, price is below the Ichimoku cloud. You can see that the cloud holds prices down very nicely, hold price down very nicely, and price is right at the Ichimoku cloud over there. Price is testing a short-term 38% retracement over here. Price is testing a longer-term 23% retracement, starting point here, ending point here. So there are a lot of reasons why this is a very strong level. So we are going to call for prices to drop from this level. Now, what has happened since then? If you scroll down, you can see how price dropped very, very nicely, right? Touch that level and it dropped very, very nicely to our take profit target, right? So you can see, we're calling for the drop to the next pullback support. That's exactly what happened. So we played it back to this pullback support over here. That is enough to make money. Okay, that is enough to make money if a good 1:1 risk to reward kind of setup. Okay, this is another example. This is another example we have, right? Notice trend line, 1 touch, 2 touch, 3 touch trend line. Price broke out of this trend line. Okay, price broke out of this trend line and it crossed below the Ichimoku. You can see it crossed below the Ichimoku over here. Very importantly, right? This is why I like this trade is because not only is there a bearish exit, this is an example of price being bearish. But if you look at the bigger trend, right, there's a very, very nice bearish channel that is still loading on so much pressure to continue to push prices down, right? To push prices lower. So you got very, very strong bearish momentum over here, right? You cross below the Ichimoku and you broke an ascending support. So we're looking to play it down to the next big support over here. And very nicely, you can see how price, it broke that level, come down, touch our take profit, right? And, it bag us out now, bag us a nice amount of pips for our profit. Okay. Now guys, so this is the setup, right? I want to create a little bit of a checklist for you guys, right? The checklist is very simple. The first thing is, what happened to trend line? The trend line, did price break out of a trend line? The second thing you need to look out for is the Ichimoku. Okay, did price also break out of the Ichimoku? Third thing you need to look out for is the larger momentum of the market. What do I mean by larger momentum? Right, you have this as the larger momentum as an example. Right, is it in your favor or not in your favor? Right, is it using a channel? So could it be a channel? Right, or could it be a big Ichimoku cloud? Or could it be a big moving average, like maybe the 100 or the 200 moving average? Okay, so once you have those three things, then you must see, did it break a key support level? So support and resistance level, you need to see if it broke a key level, right? Then lastly, you can see whether it broke a nice Fibonacci. If it did, even better, right? It broke a Fibonacci, it should trigger. If it broke the 23, it should go down to the 38. If it broke the 38, it should go down to the 50. If it broke the 50, it should go down to the 61.8, and it goes on and on, right? But you just need to know how to draw Fibonacci correctly to use this effectively. Okay, and if you have this thing checked off, checked off, checked off, checked off, checked off, checked off, is a very, very high probability setup. You're going to look at your take profit. For a take profit, look at the chart and play it to the next key level. Why do I play it to this level and not this level over here? Is because this is a big level. Price bounce over here, and since what? Since 2017 or 2018, price has not came back down to that level. So it's about 5 years since price came down to that level. It would be foolish of me to just want to play play a move beyond that. You know, this move here is enough for me. Okay, so the tighter you keep your stop loss, you know, the more profits you can make, right? Because of the better risk reward kind of setup that you have. Okay, guys. Now I do want to show you guys a couple of things. If you have the time, please try to tune in to that. Right, you can head to this site called vip.ironfx.com. I'm going to show you the registration process, okay? Because, because a couple of people are wondering how to register. vip.ironfx.com, if this is a site you want to go to, when you go there, you'll be asked to click this thing, join IronFX server. Okay, if you try to access any of the stuff by the site, I think it's all blurred out, so you can't really see it, right? So you can click join IronFX server, click register. Okay, so we're just gonna come up with a random stuff over here, right? We're gonna come up with a simple username, right, and the password. Now, when you click register, I'm going to show you the process. You need to agree to the disclaimers, as you can see over here, right? You can disable that. Join server. Now, you notice that when you join, there's nothing here, nothing that you can see. You must click on this thing called request access. When you click on request access, they say, please attach proof of your IronFX live account to get access. Click request to join channel. Please let me in. You can upload your files, right? So maybe we upload the simple picture of ourselves, maybe diamond hands. For those of you guys know what diamond hands is, it's diamond hands. Send in request. Okay, so once you send in the request, right, you can see that your request is pending approval. What happens is that on my side, I can just come in here. I can look at request management and I can see, okay, this guy has requested access, right? What has he attached? Diamond hands, right? This is proof of his live account. I will accept it. I'll give you a nice role. And once I give you the role, right, this is where you can get access to it and you can see all the different channels by the site. And this is a place where you can start asking questions, right? So imagine you're looking at this and you're wondering, okay, euro dollar, do I sell from here? You can say, hey, hey, Desmond, do I sell from this level? What level are you referring to? You just need to highlight the text. Click this button called link object to text. Select whatever you just drew. Click confirm and send it through, right? So imagine I come back here, right? I come back here and I see that someone has asked me a question, right? Someone has asked me a question. Hey, do I sell from this level? What level are you referring to? All I need to do is to hover my mouse over it and you can see it lights up on the chart. So I know, oh, okay, this is the exact level that you were referring to, right? And that is where we can help you become a better trader, right? Because I can just come in here, it's like, okay, awesome, give you a nice little thumbs up, come in here, and I say that, yeah, it looks like a nice level, and it also, right, it also seems to line up with the 61.8, right? That's why I can say it also lines up with the 61.8 retracement. Same thing, highlight this text, and I can even select the exact retracement that I'm referring to, send it through. How it looks like is that when you hover your mouse over it, you can see this is the exact tool that I was referring to. Okay, guys, this is a really, really nice, simple way that you can register for the VIP room, right? And it allows me to actually guide you better to be a better trader, right? So anytime you got questions, just send it through. All you need to do is to have a live IronFX account to get access to this. Okay, guys. Now, I do want to show you one example on crude oil on the daily chart, which I think it might be you guys might be interested in. Was it crude oil? Oh, it could have been crude oil. Yes, on the daily chart. This could be a nice setup for you guys to look at, okay? This is what I mean by applying what we've learned. We draw a trend line from here until here. So Techno is asking how to have a live IronFX account. Just go to ironfx.com. This link here, copy link address. Register for it over here. And you can get a live IronFX account. Okay. Now, anyway, back to this. Yeah. So please, if you have the chance, please just go get that, get access to the IronFX VIP room, because I believe, I'm not sure when, but they'll be increasing the entry requirements in the future. For now, all you need is an IronFX account, but maybe in the future, you know, you need to put in like a couple, like $10,000 just to get access to it, right? So if it's in a promotional stage now, so go register for an IronFX account if you don't have one, just to get access to this. Okay, once I give you access, no one can take that away from you. So this is an example of applying what we learned today. Trend line, 1 touch, 2 touch, 3 touch, 4 touch, 5 touch, 5 touches here. So this is a valid trend line. Okay, price has since broke out from the trend line, so we're expecting it to maybe drop down. Okay, so what do we do once we have identified this? We throw on the Ichimoku cloud, and we notice that price is crossing below the Ichimoku cloud. If it drops here, right, it will actually cross below the Ichimoku, which is a very nice thing. Okay, what is the support level that it needs to break? I am a little bit wary about this support level, right? We can see that price bounced off very nicely from there previously and is right there again. So we need price to break this level to trigger the move down. I believe that the next big level that it would probably drop down to is over here, right? This could be the next key level that it might drop down to. Okay, but first and foremost, it needs to break this key level, you know, trigger the move down. All right, so yeah, these are some things that you can take note of, right? That it's when you're doing analysis, it's very easy to find trend lines. You find a trend line, you throw up the Ichimoku cloud, you throw up the support and resistance levels. See, this is what I call a downside confirmation, meaning that we need to wait for price to break this level before prices go down. Okay, it's a setup which I am also watching on myself. Now, guys, we got a little bit of time here, right? I'm just gonna open the time to the floor. Is there any questions you guys have, or is there any particular market or instrument you want me to take a look at? Okay. Let me just pull it back to this level. All right. Yeah, so I hope that this webinar gave you a good idea on how to apply trend lines, you know, how to apply channels, right? Along with all different live examples, you know, how you can apply it better to your trading. Creating a nice little checkbox system. You got trend lines, you got Ichimoku, you look at the larger momentum, right? You look at which is made up by the channels, the Ichimoku, the moving average, right? You can look at support and resistance as a key trigger, look at Fibonacci too, which we'll be covering in the future webinars, right? And if you combine all of it together, right, that's where you can become a better, that's where you can decide whether it's a nice enough setup.
Hello, my name is Christina, and today we will talk about trading psychology. When you trade, psychology is very important. Feelings such as excitement, anxiety, depression, denial, and belief play a key role to your trading success. In many ways, it has been shown that the way traders feel affects their trading performance. Since it is difficult to erase our emotions, the best way to deal with them in trading is by controlling them as best as we can. More generally, the overall investor sentiment can affect how the market performs, which can be inconsistent with the actual market news and events. But let's see in more detail how psychology affects the market. The way traders understand the market has an influence on the market itself. For example, if macroeconomic data is better than expected or the numbers are disappointing, then the value of an asset will move based on how the market's participants felt about it. Sometimes, even if data is positive, the value of an asset might not move, since the market's participant expected that and had priced in it. Any trend in the market very often reflects investor sentiment and how traders felt about it at that moment. The general market sentiment is what will also guide them to buy or sell. If they believe it will go up, then it will buy and vice versa. If there is an optimistic view of the market, then commonly there is an upwards trend. On the other hand, fear is usually associated with a downwards trend. As the market fluctuates, so do the traders' emotions. Traders may feel disbelief at the beginning of a trend and then feel hope for the market to recover. If the market goes up, then traders will begin feeling optimistic and then excited as they believe the rally will continue. If the market goes their way, traders may become greedy or euphoric. The opposite will also be experienced as the market starts to change and move downwards. At first, they might try to convince themselves, then the fall is only temporary. But if it continues, then anxiety starts to settle in and perhaps denial, as they still may feel the market will recover soon. If the market remains weak, then traders may start to panic, withdrawing everything from the market and worried that they may lose what they have left. Finally, feelings of anger and disappointment will guide the market as it reaches further lows. Thank you for watching.
Hello everyone, my name is Emily. In this video, we'll discuss circuit breakers, which are temporary measures that stop trading on an exchange. Basically, circuit breakers are emergency measures that shut down trading activity temporarily or for the rest of the trading day when market prices are dropped considerably. The first circuit breaker was put into place on October 19, 1987, after the Dow Jones dropped by 22.6% in a single trading day. Let's have a look at why this happened and how circuit breakers work. Circuit breakers are calculated daily and are set at 7%, 13%, and 20% of the closing price of the S&P 500 for the previous day. If the S&P 500 index falls by 7% in a single session, a level 1 circuit breaker is applied. Trading is stopped for 15 minutes to give traders the chance to reassess their options and stop panic selling. If there is improvement when trading is reopened after the break, the session will continue as usual. However, if the S&P 500 continues to fall and drops by 13% before 3:25 p.m. New York time, a level 2 circuit breaker will be applied and trading will be stopped for another 15 minutes. If the fall continues further and drops by 20%, the situation is considered critical and a level 3 circuit breaker will be applied. At this highest level, trading is stopped for the rest of the day regardless of what time it is. The question now is, are circuit breakers used only for market indices? No, they're not used only for market indices. Individual securities have their own circuit breakers known as the limit up and the limit down rule. This means that trading is stopped whenever the price moves too far up or down away from predetermined acceptable levels. Thank you so much for joining us today, guys. See you next week. Bye-bye.